It's a great pleasure welcoming you to the National Institute of Economic and Social Research. I'm Adrian Pabst. I'm NIESR's Deputy Director for Public Policy. And it's great to see so many of you here today for the 2025 Dow Lecture. Established in honor of the prominent economist Christopher Dow, a former Deputy Director here at NIESR and an Executive Director of the Bank of England, the annual Dow Lecture on macroeconomic policy is one of 5 public lectures that we host here at NIESR every year. Former speakers include Professor Martin Weil, who I know is with us. Martin, welcome back. James Bullard, who is the CEO of the Federal Reserve Bank of St. Louis, and also Professor Silvana Tenero, who's an external member of the MPC. Now, that brings me to this afternoon's Dow Lecture, the 2025 Dow Lecture. Dr. Swati Dhingra, welcome, and thank you very much for accepting our invitation. I can't think of a better person to talk today to us about trade fragmentation and monetary policy. With everything that's going on across the Atlantic and indeed in the world economy, I think we're enormously privileged to have Swati with us here this afternoon. She has been an external member of the Monetary Policy Committee of the Bank of England since 2022 and has just started her second term. As I think everyone knows, she is an Associate Professor of Economics at the LSE and an Associate of the Centre for Economic Performance there, a group we work with very closely, and we're really delighted to be able to call her and others there our close colleagues. She graduated from the University of Delhi and the University of Wisconsin-Madison, as well as completed a post-doctoral fellowship at Princeton University. She's been funded by a number of research councils, including the ESRC, and was also awarded the ONS's Research Excellence People's Choice Award in 2019. In 2021, she was elected to the Council of the Royal Economic Society, and her first appointment to the MPC was on the 9th of August 2022. So in this world of incredible upheaval, I think this title, Between a Shock and a Hard Place, is really a wonderful way of discussing trade, fragmentation, monetary policy here this afternoon for the 2025 Dow Lecture. So please join me in welcoming Swati Dhingra.
So let me start with saying, I know it's customary to have a script in front of you and be reading. I'm just not of that generation, so I'm going to only use slides. Slides had made their way by the time I ever started doing economics. So those of you who are younger, and the many of you in the audience, you don't need to do a scripted lecture. I know we feel really awkward about it. So let me get straight to what I wanted to talk about, which is trade fragmentation and monetary policy. And I'm going to start with actually saying how delighted I am to be giving the Dow Lecture for 2 reasons. The timing is just really, really spot on. And I don't say that just because of where we find ourselves in terms of the global developments, but much more so because actually last week I was in Belfast and Newry for a regional visit to Northern Ireland. I don't think there are many places in the world where you're going to feel the gravity of international cooperation to the degree that you can at absolutely, the pinnacle of that debate in particularly this country on international cooperation, and more specifically on the Brexit border, is where we were sort of standing and visiting people. And surprisingly there, something that I didn't know about, I got to know that there's a very intimate connection between NIESR and Newry. Does anybody here have any knowledge of that other than the NIESR people? So NIESR has actually come up with a global modeling tool for the all-island economy, which means UK, Ireland, Southern as well as Northern. And there was a huge buzz in the place about how they were going to be using that to be able to think about, Bank of England interest rate hikes or decreases, as well as trade more generally. And in fact, I'm going to use some of that towards the end of my lecture here. Some of the very same tools that go into the macro modeling for the all-island economy are also things that are going to motivate how I'm going to think about what is happening in terms of potential impacts of trade fragmentation in the future with the recent sort of policy developments that are going on. So let me start with a broad overview. I have about maybe around 10 slides. I'm going to go through them slowly. Most of them are pictures just based on work that's been done, either by researchers or by policy makers as well as bank staff. So broadly speaking, this is something seems to be ringing, but I don't think it's me. So just to give you a sense of where we're today, which is, with new questions being raised about international integration, one thing that you might ask is, well, is this something new? Is this something which is really that's come upon us sort of somewhere out of the ordinary after years and years of globalization progressing the way it did, greater and greater global integration? But this is a very basic graph that I think almost every undergraduate trade course that's ever taught will have within itself. And now these are just sort of being amplified with more and more years being added. And broadly, what you can see is that trade has always had periods of openness, periods of retreat, protectionism coming, then liberalization, and these things almost go in cycles. So from the period which is around here, which is, the pinnacle of the Industrial Revolution, what we see is Britain being at the very forefront of globalization, and that being a very motivating force behind why international integration proceeded the way it did. Of course, then comes the interwar period when there's a resurgence in protectionism, primarily driven by smooth trolley tariffs. And then we get to a point where after the interwar period is over, you get to a stage where everybody sort of starts to appreciate the importance of stability. These are trade, this is trade by GDP. I should have been more careful to put those numbers on the graph. Okay. So I'll try not to move and be very stable here. But it goes from the interwar periods to the post-war period, where suddenly everybody realizes that a lot of what happened during the era of protectionism might have been beggar thy neighbor policies. And as a result of that, what we end up with is a period where the gap comes into being, where transport technology improves very rapidly. And as a result of that, what you see is goods crossing borders at almost unprecedented rates at that point. Then, of course, comes the period which in more recent popular press has been labeled hyper-globalization, which is to say trade by GDP rose at very sharp rates during this period. And this is when we see, a lot of sort of not just trade going across borders, but foreign investment, services, all of this really starting to ramp up. And then we get to the period which is much more sort of post-GFC, though some people will date it slightly differently, but somewhere around the global financial crisis is when you're going to see the period of what is now being called globalization, which is to say that trade by GDP starts to stagnate at this point. And this is roughly where we're now. If you go a little bit further than this period, which is pretty new data, most of the literature will tell you that now what we're seeing is trade actually growing faster if you look within trading blocks. But if you look across trading blocks, that seems to have really stagnated very strongly. So that's roughly where we're at in terms of the broad trends in globalization. And sorry for that, these are trade by GDP numbers. So this is trade intensity, as we would call it. So let me go from there to talking a little bit more about globalization. So globalization, just sort of to put it right at the outset, this is a slowdown of global trade growth. This is not to say that suddenly we're in a period of reversal. We haven't seen those big reversals in any kind of very significant way. The place where we can see it in somewhat of a more significant way is China. And that's really what's driving a lot of the overall aggregate trend that you can see in terms of globalization. If you start breaking up the world trade numbers into countries, you're not going to see something very uniform happening across countries and nor over time so much to the extent that you can sort of in the aggregate numbers. In fact, you see some countries where, globalization actually, trade by GDP actually goes up, only then to come down in the more recent years. That being said, I think almost every trade economist who's worked on this topic will pretty much agree that even though trade by GDP or openness more broadly interpreted has slowed down, we don't think there's been a reversal, but there has been a very significant shift in public attitudes as well as in terms of trade policies that are being implemented. And that's a little bit what I'm going to show you in the next slide. So So what I've built on is a lot of the work. This is the handbook, the most recent handbook chapter by Colantone, Stanek, and Ottaviano, one of my former colleagues, which has been looking at what has happened to voting patterns in the sort of last few years. And of course, a lot of their interest was prompted by the debate over deglobalization and the political backlash against globalization, as they call it. But broadly, what they're trying to do is they're going to try and collect as many votes as possible from about, I think, 22 different countries in their data set that they can get access to. And they're going to try and take these political parties and map them between one of these sort of broad four categories. Are you economic nationalists, which is to say that you favor more sort of isolationist policies, more protectionism? Are you somewhere on the pro-trade left or the pro-trade right, and so on and so forth? And what you can see happening already is that in terms of vote shares, the cumulative vote share across all of these 22 different countries seems to be moving much less in a pro-trade direction. You might say more in a trade restrictive direction. Both of those things seem to be moving, so it's not quite 100% clear. It's just one of those moving. What you can also do is go beyond that, and this is fairly new measures. I can't assure you that these are 100% coverage because this is really based on Global Trade Alert by Simon Evlett, sort of recording almost every day or with notifications coming in about what the different new measures are. But broadly speaking, as long as the methodology is consistent, even if there are some exclusions, I think the broad trend is quite revealing, which is to say that the purples are the liberalizing trade policy measures, which is to say that they tend to open up markets, while the blue ones here are the trade restrictiveness, the measures that are more trade restrictive. And what we can see is that there is a pretty substantial increase that happens somewhere after sort of around 2018. So in the more recent periods, we can see a pretty big ramp up in terms of the restrictive trade policy measures. And this is roughly what the reason behind Colantone and all, and in more of their recent work, them arguing that we're seeing a shift in public sentiment as well as a shift in policy attitudes towards more restrictive trade policies, I wouldn't go as far as saying anti-trade policies, because it's not as though people are saying they don't think trade is beneficial for the economy. It's more that they think that it hasn't had the effects that they would have expected it to have. So that's roughly what we gather from some of these studies. I'm going to go from there to say, well, within the handbook chapter, what they also talk about is what is the big major shift that actually happened. And that was the Brexit referendum, which set off the stage for that people were no longer thinking that established trading relationships are what they want to amplify, but there was a reset in terms of major trading relationships. And naturally, I've done a lot of work on this, so I'm going to reference some of my work as well as work of my colleagues and many others within the UK economy. Suddenly, we have an enormous interest in international trade, and that's been excellent for the discipline. That there's a lot of work happening, and we know a lot more now about what the impacts of that sort of resetting of trade relationships has been. So the first place where things mattered was that on the night of the Brexit referendum, sterling had a very, very substantial depreciation. This is in fact the biggest one-day drop that has ever happened in any of the four major currencies of the world since Bretton Woods. So what we see is before Brexit actually happened, before the referendum results come out, there's pretty much a tick up that's going on in sterling exchange rate relative to the dollar as well as relative to the euro. A little bit of a bump up that you can see is to do with when the Newcastle vote came in, a little bit from the Gibraltar vote and so on, very much in line with expectations. The Newcastle vote was a little bit of a sort of surprise because people thought it would be a bigger majority for Remain, but it didn't turn out to be so. I should mention I was giving a talk at LSE in the election referendum night just before this event happened, and somebody from the audience, just like one of you, asked me whether they should take their money out of the pound. My response was the bookmakers haven't changed their odds. I haven't seen anything happen. The next second was when this dip happened. So I have very little credibility in terms of predicting political events, but I hope at least I can show you that I do understand what the economic outcomes as a result of that could be. So roughly speaking, the Sunderland vote was where things, when the Sunderland vote came out with 60% plus majority in the time, in area that people really started to think that this would coalesce towards becoming a vote for leave. And what you see is a really substantial drop, much bigger drop in the pound against the dollar, which many people think is a safe haven currency, as opposed to the euro, which many people at that point thought was also exposed to the Brexit shock. As a result of that, what I'm going to show you next are the prices. But before that, I'm going to talk a little bit about, our immediate reaction when we look at depreciations is to think about prices, but it's not just prices that we consume directly in terms of imports, but also imported inputs, which are really important for international trade these days. In fact, all of the increase, not all, but a very large proportion of the increase that we saw during the hyperglobalization period was a result of countries becoming more and more integrated into value chains, and the intermediate inputs were what was driving the really sharp increase in trade. What we see happen here is that what we did was we looked at what all different sectors of the UK economy, what is their exposure to imported inputs, and particularly imported inputs coming from the US versus the Euro area. And we can split those sectors into two different groups. One are the ones which are below median depreciation. Those that are less exposed to the depreciation that happen, and those that are more exposed to the depreciation that happen. And what we can see here is that the real wages continue to grow at very much the same pace that they had been growing at for the purple ones, which are the not so exposed sectors, while the ones that were more exposed tended to see a slowdown in wage growth. And in fact, if you look at the AWE numbers for the aggregate UK economy during this period, what you'll see is a period where it's completely flat in terms of real wage growth. And that's really what we think is this driving this kind of increase in imported input cost pressures that are driving that slowdown in wage growth. I'm now going to show you more of these sorts of pictures. So this is looking at what happened almost immediately after the resetting of trade relations that the Brexit referendum signaled. So Euro area prices continued to grow at the same pace as they were growing. They were increasing in general. While if you look at the UK area, it starts to diverge quite substantially from the Euro area. If you look at food prices, there the sterling depreciation really started to have a bite, because food prices in the UK really increased relative to food prices in the Euro area. This is very different from what we saw in the recent inflation episode, where if you looked at German food price inflation, it looked pretty similar in growth rate terms, not in level terms, to the UK. While during this period, we don't see that kind of effect. Overall, though, you would have thought that this could have had some very strong inflationary persistence effects, largely because this is a period when inflation had been very subdued, but that's not what quite you see. In fact, this was pretty much seemingly a one-off adjustment that was going on in price growth terms, and then it sort of comes back. So I can talk a little bit more, and this is going to be the end of what I'm going to talk about in terms of the first episode of resetting of trade relations with the UK, which is, well, what happened when Brexit really did take place, not just what were the effects that had been brought on by the sterling depreciation, which in some sense has been a pretty stable depreciation, that sterling didn't really go back to its original value, its pre-referendum value. So this was this is work from my colleagues at the bank as well as the Center for Economic Performance. And what they've done is looked at HMRC data and see what is happening to different firms by the quintile of employment. So the quintile 1 are the smallest firms and quintile 5 are the biggest firms. And this is showing you what's the percentage change in their exports relative to the EU, relative to the rest of the world. So the idea is, this is how most trade economists are going to think of when they want to see whether it's really trade costs driving changes in trade patterns. You want to be able to tease apart what might be general trends going on versus what might be due to the trade costs that we think can be attributed to the TCA. And what you see here is that there's a very sharp drop in the smallest firms. Now, of course, during this period, there's a lot happening. There's COVID, there's the Ukraine war. There's also the issue about the readjustment of the statistics after the EU has gone from being a dispatch to an export. But all said and done, with a lot of adjustments having been made, most people think that the fundamentals of what my colleagues are capturing is actually probably correct, which is to say that there has been a drop-off in small exporters and their ability to sell to Europe. And this is something which shows up in many of the other business surveys as well. In terms of sort of prices, again, so this is now different from the prices that I was talking about earlier, which is to say those were driven by the sterling depreciation. This is now after the TCA has come into being. What we want to understand is what's happening to UK prices. And this is taking all of the UK's consumer price microdata, splitting it up into 4 categories, which is those that have low trade barriers with the EU to those that have very high trade barriers with the EU. And these are only food prices. And this is work that Richard Davies and colleagues at the CEP have done. And what they're showing here is how many, the orange lines are telling you how many food prices actually went up month on month, and how many, the blue ones are telling you how many were actually going down. And what you can start to see here is that the gap really opens up where the trade barriers exist, but not really so much in the low trade barrier numbers. That being said, again, what we've noticed till now, just like in the case of the referendum, here the overall economic activity impacts as well as the inflation impacts are not, they're pretty subdued for the reason that, one, we're talking about small businesses. It is impacting some high value added manufacturing, but broadly at the moment, most of the evidence is coming from small businesses. On the pricing side, most of the evidence is really from food prices, where there's been a one-off increase, not really inflationary persistence, which carries on and pervades the economy. So up till now, that's really the evidence that we have on major resetting of trade relations that we saw is with the start of the referendum and then culminating in the TCA. I shouldn't say culminating, there might be other changes that potentially can be attributed. So let me sort of pause here now for a second and just sort of give you a bit of a brief up of what I've said till now. What I wanted to kind of get across to you was that deglobalization is sort of not a new phenomenon, or even we've seen this happen again and again. More or less what we think where we're at is a period of globalization. Going forwards, the public sentiment as well as policies have changed, and one of the biggest resets with Brexit. What we saw from the Brexit referendum was some sort of impacts on particular activities, particularly small business exporting, as when it came to the actual departure. But till now, not really very compelling evidence to say that there has been a resurgence of inflation coming from these sorts of resetting of trade relations, though there have been changes in price levels over time. So now all of that pretty much is going to look fairly benign compared to the really big shocks that we're going to see with the pandemic and the Ukraine war. And some of my work since I went to the bank was to think about what are the actual impacts, how can we try to measure how much is imported inflation versus domestic inflation. And we've been updating some of this analysis every now and then. So I'm going to show you today what are the latest numbers. But let me start with 2022, just because it's important to get an understanding of how big the global factors were in influencing inflation during this time period. So this is showing you on the pie chart on the left what the value of the consumption basket is. So if the value of the consumption basket is 100, then within that value, 3.6 would be the typical number you would see, that this is how much energy consumers buy as part of the household consumption basket. So that's the 3.6% number here. The 4.9% is what consumers are buying directly as imports. It doesn't mean necessarily directly, but pretty much in retail terms, these are cars, imported cars coming into the country. Now, the problem with this sort of picture is that if you only look at final energy use and final import use, you're going to have a very small estimate for what is imported inflation, because a large part of where inflation comes from abroad is through these imported inputs, which then are embodied in the goods and services that are bought domestically. The example I love to give, which yes, you reminded me a couple of days ago, I've been using too often, is bread. Yes, you buy bread domestically, but within that bread is wheat, within that bread is, potentially sunflower oil, things that you are getting from abroad. And in this particular episode, with the Ukraine war, with Russia and Ukraine being the biggest wheat baskets of the world, that's of course going to be impacted, even though that's not going to show up in the usual statistics as domestic inflation. So what we've tried to do is to go to the supply use tables. This is the supply use table from 2019. I haven't had a chance to update the one which came out 5 days ago, so bear with me. Some of these numbers might change a bit, but I think they've generally behaved quite stable, so I don't think it's going to be very big changes. Which is to say, that 13.5% is energy that you buy as an input, which is embodied in other goods and services that are available to UK consumers. And similarly, 16.8% is the number which is coming from, other inputs that you're buying from abroad, which imported inputs, basically. So energy can be both produced at home, produced abroad, but as we know, it's really the prices of energy are really influenced by global factors, not really very much by domestic factors. They're traded on regional markets as well. The rest of this, which is the orange-yellow bits, which is what most central bankers are very worried about, which is domestically generated inflation, that's the bit you can see in the oranges and the yellows, and that number is roughly 60%, and the rest of it, which is energy and imported inputs, is about 40%. So going from that number originally of 3.6 plus 4.9, you end up with a number which is almost 3 to 4 times bigger. And what we can also do once we've constructed this kind of, division between domestic and imported input use, we can also say, well, how much of CPI inflation can be attributed to the different costs that are incurred, energy costs, wage costs, and whatever is left over, what we can't explain between prices and all the costs and taxes that we've accounted for, we're going to call that firm surpluses. Of course, those could be things that are going to pay capital, but we don't have very good measures of profit margins. So that's about the best we can do in terms of being able to get a handle on the residual claims to prices. So the CPI numbers, I think it's worth looking at, which is the 10.8 percentage points of the 16.8%. So 16.8 is how much headline CPI rose in 2022 compared to 2019 prices. This is not showing you annual inflation for the reason that you're going to get COVID and, sort of strange stuff happening with those statistics on doing the comparison from 2019 to 2022. And what you can see here is that a very, very substantial part of headline CPI inflation was driven by energy and imported inputs coming from abroad, imported consumption goods as well. You can also start doing that with metrics that people like to look at, core services. They're good metrics to look at under normal circumstances because they tend to embody a lot more domestic costs than, headline CPI inflation, which has goods inflation within it that we buy from abroad to a larger degree. But even there, you can see that there is a very substantial component that's embodied in them, which is energy and other imported inputs. And of course, food and non-alcoholic beverages is going to be really sort of very, very big proportion is going to be from abroad. I'm going to take this picture on sort of 2 years now, which is to say in 2024, what do we know? This is the latest data that we have because services inflation don't come out. They only come out once a quarter. And once again, the numbers here don't change very dramatically. They remain about 40%. We're going to update as soon as possible with the latest tables that have come out. And if you start looking at CPI inflation and the other sources, the other metrics of inflation, once again, we see that about a third of CPI inflation still during 2024 was driven by these factors which were influenced by global shocks rather than necessarily what's coming domestically. So from here, I'm going to show you where I want to sort of convince you is that if you want to think about inflation, you're going to have to really think very seriously about global shocks because that's fundamentally what's driven a lot of the variation in CPI inflation over sort of the entire sort of last 2 decades. Sometimes in the direction you want it to go, which is that it's keeping prices under control, and sometimes, with the huge terms of trade shocks that we saw in the last few years. So this is roughly giving you that broad picture here. And what I want to do next is to sort of move on from having talked about, the big changes that have happened in the trade landscape, whether that's globalization, whether that's the Brexit resetting of trade relations, whether that's the Ukraine war and the pandemic and everything else that came with global supply chain disruptions during that period. I'm going to now try to look forward a bit and say, well, if there is a reset in US trade policy, what is that going to mean for the UK? How can we think about it? I'm not going to have very precise numbers for the obvious reason that we're not even certain at this point what that policy mix is going to look like. So instead, I'm going to give you some of where my thinking is. And, I'm very happy to get suggestions and think about where some of this modeling can be improved. And I'll talk a little bit about the work that NIESR has been doing in this regard as well. So the first thing is, I don't have to convince you that it's really uncertain what's going on. Nobody seems to have very good idea of what precisely will be the policies that will come into being. And one way of gauging that is to look at how many newspaper reports are mentioning trade policy uncertainty. I should mention, I've done that even in a previous talk, trade policy uncertainty measures that come out of newspapers, the moment people start losing interest in the news story, will start to look like they've gone down, even though in principle, uncertainty may not have actually gone down for businesses. So that being said, actually even businesses do that. If you look at the CBI services, things just immediately go down once people have got bored. So these are not great metrics out there, but they give us a sense of what people are thinking about at that point in time. Okay. So sorry about that. So let me wrap up with some of these things and I'll walk through what these issues are. So the first thing is what we expect to happen can take sort of two directions. One is you could think of what we would expect to be the normal fragmentation scenario, which is the somewhat orderly fragmentation. That is to say, you will see tariff measures come into being, like they did in the previous Trump administration. You would see retaliatory action. Many of these things can happen fairly quickly. For example, China responded within 10 days in the first Trump tariff war. The EU responded in about 3 weeks or so. So broadly, those are the kinds of changes that would happen. The reason I'm calling these orderly is because we know what shape these take, which is to say there's an increase in tariffs, which is an increase in trade costs, and there's a response to that by trade partners who want to try and put punitive countermeasures to it. In terms of the UK, a lot of what the commentary, at least till some time ago, was really focused on thinking about what might happen to prices, but from the point of view of the US. In the US, many economists will tell you they expect inflation will increase because you're putting on trade costs, which you otherwise would have bought without these trade costs. So fairly straightforward to think about that sort of price increasing effect of tariffs. For the rest of the world, this is a much more complicated issue. And the reason it's complicated is, yes, we buy stuff from the US, and there might be some reason for the US for facing higher trade costs themselves to pass on some of those trade costs to the UK. But they're also looking for new avenues to send their goods to. And particularly if you were thinking, say, of Chinese exporters of steel who were selling to the US and now find that that market has shrunk or has become sort of more constrained because of the price increases that they're faced with through the tariffs, are now going to look for new avenues for where to sell their products. And that could put downward pressure on global prices. Now, what evidence do we have? I think the best thing to look at is the previous Trump tariff war. At least that should give us some clue of what might ensue this time. And I'm somewhat more encouraged by things here. One is to say that actually the direct effects that we face of US tariffs, which is to say what US firms are selling to us, is contained. It's about 10% of the UK import basket. And within that 10%, the top 5 imports include crude oil and refined oil, where we don't think there's going to be some really sort of serious increase in trade costs being passed on to UK consumers. The second thing to look at is what happened to global prices during this period when the first Trump tariffs came into being. So in the initial phase, actually there wasn't any kind of reduction in global prices. But then came the steel tariffs, the aluminium tariffs, and over time, as those pressures built up, what we saw were very substantial, almost 50% decreases in Chinese steel, which many of the US researchers have studied in great detail. If you look more broadly at the World Development Report 2020, what you'll find is they have numbers there for how much import value, how much trade value changed, and how much trade quantities changed. And if I do a very back of the envelope calculation, you'll end up with a number of 8 to 18% reduction in global prices. So in that sense, there was this kind of price reducing impulse that came as a result of tariffs. In some sense, not very surprising for anybody who knows the basic rationale for optimal tariffs. The whole point is if you're a big country like the US, which has a very substantial footprint in the world market, you can put terms of trade in your favor by taking that demand out, by putting on tariffs so that your exporters are forced to, people who sell to you are forced to reduce their prices. And that's a little bit of what's going on here. Now, this is somewhat complicated by the fact that UK imports, about 35% of them are also invoiced in dollars. And if you go by, now nobody really has very strong sense of where, this is not as clear-cut a case of what might happen to the dollar. But broadly, if we go by when the new announcements came in of the Trump trade policies, what we saw was a jump up in dollar, basically dollar strengthening. So if at least in the short term it behaves like that, which is to say that the dollar appreciates, what we would expect to see would be that's going to put upward pressure on UK prices because 35% of our imports are being invoiced in the dollar. But that being said, it is 35%. I mean, 27% is sterling, 20% is the euro. So in that sense, there are those other sort of offsetting forces which are going to come into play as well. So my broad sense from thinking through all of these things is that what I expect to find would be that the negative impulse is probably going to be there and it's going to be big enough that it's a serious contender to offset the dollar appreciation that would put upward pressure on UK prices. In terms of economic activity, what has been pointed out, and a lot of trade modeling work has happened, including by my colleagues in the Grantham Research Institute, people at the CITP at Sussex. And what they're finding generally is that if you were to look through the lens of, say, a quantitative trade model, or even if you didn't go that far, if you didn't believe in any modeling and you just wanted to say which sectors are exposed and what they're exposed to, you would come up with sort of negative effects coming from the increases in trade costs for UK exporters to the US primarily, but also to other countries. And what you would expect to find would be that the really vulnerable sectors are going to be transport equipment and to some degree pharmaceuticals and electronics, because those tend to rely much more on rigid supply chains of partners that are likely to be affected by these trade policies. I think the pharmaceutical industry is the one that I would worry about a bit in terms of where the sectoral vulnerability is. We're quite integrated with the US on that front. And the US, in turn, for some medicines is highly integrated with China. So that possibly can have knock-on effects, which would be fairly troublesome for people. There's also what I'm trying to sort of shy away from giving any firm numbers, because I've already told you, I think the trade policy uncertainty numbers are very, very difficult to quantify. And broadly, what we know from the previous Trump trade war is that the previous Trump trade policy had somewhat, because it was uncertain over a period of time, had a negative effect on investments. And the general number that people will tell you is 1.5% drop in investment over a year. So I think those features are fairly easy to understand. But if you went to macro modeling, like the kind that's done in Niger at NIESR or the ECB global semi-structural modeling, you're going to actually amplify some of these negative growth effects in the global economy, partly to do with financial channels starting to have their bite as well. Now, these models give very different results. I mean, they don't even agree on the direction of what might happen to inflation. So in that sense, the financial channels is where a lot of this uncertainty is. I know this is NIESR. I know I should agree with everything. I think some of those channels are somewhat large because they tend to model low substitutability across different origin countries. So I think that's really going to be something which we're going to have to think about. So let me go from there to sort of saying where I think inflation is headed. No Bank of England talk is complete without giving your policy views at the end. So I'm going to do exactly that. Hopefully it still connects up with the rest of my talk and it's not just, pasted in right at the last minute. But broadly speaking, what I think is going to happen is as the reorganization unfolds, as long as there's some sort of orderly fragmentation, this is going to be somewhat of a one-off adjustment. Of course, there's going to be a transition period, but broadly, we're going to see some reorganization. And that should sort of be somewhat, businesses and consumers should be able to deal with that with, of course, some increases over, some one-off increases that might happen. I think some of that pressure, though, is going to be taken off by the global price and the global growth dampening that's going to happen. In terms of sort of if things moved in a more ad hoc, disorderly fragmentation direction, which is to say that everybody starts to emulate trade policy in ways that restricts supply to very, very specific locations. I mean, then we're looking at a lot of pressure on supply chains, and that's of course going to be going to create sectoral shocks as well as possibly even critical inputs becoming weaponized to try and to try and sort of gain advantage. I think in that case, we should expect that supply shocks are going to become a more prominent feature, which means then inflation starts to matter, inflation persistence starts to matter, and volatility starts to go up. That being said, I think that's a fairly extreme scenario, because what it requires is not just the US trade policy to go in one direction, but also everybody else who's a large economy to follow in that direction. So I think that that's a fairly extreme scenario. Of course, I'm in the business of thinking about extreme scenarios, so that's something I want to take into account, but I don't think that's the central scenario anyway. In terms of sort of what that means, more and more, I think what the last few years have taught us and what the possible trade fragmentation going forward is going to highlight to us is that, aggregate statistics are just not going to do the work for us this time. We need to think about what sectoral shocks do. We've already witnessed that in the case of energy price inflation, food price inflation, and that understanding these sectoral impacts, thinking about these trade interdependencies is going to be really crucial. Unfortunately, we're very far behind in terms of being able to understand these things and in being able to even map them in any kind of precise way. And that's really what, a lot of the central bank reviews are putting on their agenda. And I think that sort of becomes much more urgent, much more pressing at this point. And going forward, if these supply shocks persist, that's of course going to be an agenda we should be thinking very carefully about. I'll stop here. Thank you for listening.
Well, thank you so much for an incredibly rich lecture. And we're now going to have some questions, and I'm going to take them in groups of 2. So there'll be plenty of opportunity, even if you don't get the floor the first time around. So let me see who would like to ask the first couple of questions. So we've got Stephen and gentleman over there. So Stephen, why don't you start? Please do say who you are, just very briefly.
Stephen King from HSBC. I just wanted to ask about the context in which tariffs are applied. So if you go back to Smoot-Hawley in 1930, the context was one, I suppose, of huge stock market crash, sort of disinflation, shortly afterwards collapsing financial systems around the world. And you might say that the inflationary impact of those particular tariffs is small because it's swamped by everything else that's going on. You go to the Nixon shock in 1971, very different kind of backdrop, in which case the tariffs seem to magnify an underlying inflation problem. You showed a chart in your presentation which was looking at the contributions to UK inflation. And one striking feature of the chart is, of course, that prior to COVID, the contribution from wages was very, very small. The contribution from wages post-COVID is significantly higher, if you believe the wage numbers, which you may or may not do. And I'm just wondering whether, if the context has changed domestically with regard to inflationary dynamics, does that have an impact in terms of the way in which tariffs themselves may feed through? Thank you.
Hi, I'm Costa Villas from the University of Liverpool. As it happens, I also want to ask about wages. So in your graphs, wages account for something like 35% in the latest part of the period. So I assume this is the aggregate measure of wages, is indeed. Or is it, do you distinguish between private wages and public sector wages? And I'm asking that for the very simple reason, as you know better than me. Last year, HLRs authorized public sector wages of around 5.5%, which are much above inflation. And there has been literature in the area which shows, also an area study by the National Institute, that there is a significant feedback from public sector wages to private sector wages. And this feedback can take up to 1 year. So my question is, do you worry about the latest increase in public sector wages? And does it make sense to try to break down the differences between sectoral wages? Because you mentioned the sectoral issues in your presentation. Thank you very much.
Great. So I'll start with the context. I think the context really matters. And in fact, if you go back to David Walton's speech that he gave many years ago about the oil price shocks and saying actually oil price shocks have stopped having the kinds of effects that, that you would have normally expected from terms of trade shocks, that was really important. Labor markets were loose and so on. While if you look back at this shock when the right labor markets existed, we saw that those then did end up sort of having second round effects. So I think I'm totally on board that, yes, I think the context matters, and that's probably going to be critical at this point too. That being said, if you pull the axis far enough away, you would put COVID and the sort of aftermath of COVID and possibly as saying that was as big a depression shock as possible. I mean, I'm open-minded about that. I don't have a strong conclusion of which way that should go and whether the reaction is going to be particularly different. That being said, so let me get to Costa's questions. So in this setting, what we've looked at is sectoral wages, which is to say, there was always a lot of, I've been in the minority for too long. I've always been on the defensive and not the offensive. So let me just put it in context of that, which is what is the wage measure being used here? I actually tried to use as much of an inflated wage measure as possible for the reason that that meant that there would be less being attributed to imported inflation. So it was more to say that here's the upper bound of where domestic inflation could be. So it was designed with that sort of idea in mind. So which is why what we're using is sectoral wages, and on top of that, we're just adding in retail wages as another cost that's incurred, say, in the distributional sector. Now, that being said, we aren't really making a distinction between public sector and private sector in any meaningful way, and that's something I should think about, as well as the bit about, how much is regular wages and how much is other, arrears, bonuses, etc. That's not quite embodied in here in any meaningful way, and we should really be thinking about that. I agree.
Right, thank you very much. Taylor, and then the lady here in the front.
Thank you, David Robinson, Market News. The official policy of the bank or Monetary Policy Committee has always been to take policy as given, government policy. If you then think of tariffs and Trump, where it's used as a threat, and each morning we get up and find a new announcement, does that make it very difficult to take policy as given through forecast rounds? And something I asked you about one time before is, does that give you a temptation to make the uncertainty, the drag from uncertainty, the known factor that you model in? And the actual level of tariffs is something you don't want to model in the quarter forecast rounds.
Yeah, sorry, thank you. Nina Toxos, I'm an independent economist, retired now. I spent most of my life looking at emerging markets where inflation is an ongoing thing. It's it never goes away. And when the inflationary pressures began here a few years ago, I thought there were two things that there wasn't enough focus on. One was currency depreciation, which I think wasn't quite focused on. The pound falling in the aftermath of Brexit and the weakness from that, and the huge current account deficit. I mean, I can't see where sterling is going to go really with that current account deficit. And so there's that one. The second one is profit markups, which I feel, there's been a bit more discussion about that, but really everyone focuses on wages, but there isn't enough on profit markups. And I think that's a issue that really does need to be looked at.
Thank you.
I'll go ahead. Sorry, I'm going to start with you. And so actually, I'm resistant to putting uncertainty in, not because I think it's not important, but because I just don't know how to put it in. So it's so difficult to measure, and anything goes answer will then become the norm. And that's the reason why I think it's probably better to just keep an eye on what's happening to investments, what's happening to, what a business is telling us, I feel like we might get a better handle on the problem through that than trying to do some very sophisticated modeling of it. That's broadly my view of it. It's not that I don't think it should, that it's not important enough to be there. It's just a matter of, it is important, but I don't know how to discipline the question. So it's better to discipline it by what we're hearing from businesses as well as agents and so on. On the point of, this is something which we take as given that here's the policy that's been announced. I think that's fine, and that's a lot of what this is based on. When when in the last MPR there were predictions about what the impacts might look like and so on and so forth, were based on what the announcements were. But that being said, there's nothing wrong with trying to think about what an extreme scenario on either side might look like, and that's a little bit where I'm coming from, which is, as the person who's an international economist on training on the MPC, I feel like it's my duty to be thinking about what the actual impacts could be if things were to fragment in a very disorderly way. But I'm not sort of saying that that's somehow a central scenario. I don't find that plausible either. In terms of sort of sterling depreciation, I think it's a hard question because, it's not as though we have a policy of trying to prop up the sterling. And that's something which is then going to have impacts in terms of inflation. Now, to what extent should we worry about that? I think the trade impacts of that and how those determine sterling are actually probably not as important as the ones which are going to come from the financial channels. So I almost feel like I find it very hard to predict where that might go and how quickly that might change. So it's better to think of as we get the information to react to that, rather than to have a very strong view on where things might be, a year and a half, 2 years from now. Now, that's not a great position to be in, I understand, but I don't have better tools to be able to do better on that front.
Thank you very much. The gentleman here and then the lady over there.
Thank you. Thank you for a very policy relevant topical speech. I wanted to ask you about the monetary policy implications, what you have there, particularly in the third column of your last slide. Some of your analysis is based on looking at the impact of tariffs during the first Trump administration. But what we are at least facing is a much, much larger order of magnitude and coverage globally than last time. Just one example, what has gone almost under the radar, the Chinese tariffs, are equivalent to the entire increase in tariffs last time. As we have been sitting here, Mr. Trump has said the Mexico and Canada tariffs will go ahead. We already have steel and aluminum, which is much larger than last time. And the threat of European tariffs because of VAT differentials is extremely large. So in that context, if we are faced with this kind of shock, what do you think? And if these, we don't know if these are serious or not, they appear to be, but we do not know whether they're simply a threat or a reality. But if they are a reality, how do you see the monetary policy implications?
Thank you, Rebecca Driver, analytically driven. Thank you very much for what was a really interesting talk. I was very struck by, but not necessarily surprised by, the chart that you showed breaking out the impact of Brexit on firms by different size. And small firms typically have much lower productivity than large firms. So I wondered what your assessment of rising trade barriers was for potential productivity growth in the country, given that you've got a situation where, on the one hand, for smaller firms are less able to export, so may see a drop in their share of GDP, but on the other hand, they're also sheltered behind higher trade barriers as well, and therefore may survive for longer.
I'll continue thinking about that. So let me go first to your question, which is, the magnitude of the trade barriers that are being proposed this time are much larger. So just in terms of context, that even in the last Trump administration, the barriers that were originally proposed were much larger than the ones that actually went into being. But this time, I think at least the coverage itself is so much larger that probably that's going to matter. My general sense of that, and again, I can't say with great authority because we haven't had these kinds of episodes in the recent past very often. So, and since the last time when there were really big increases in trade barriers of this kind, the world economy has changed very dramatically because of value chains, and those tend to amplify these effects quite substantially. So, my sense though is, if I were to take a bit of a view on where I think that would go, my sense would be that actually that's going to mean that the price reducing effects are going to dominate, which is there's going to be a bigger impact on global prices, more pressure on firms to try and the exporters who would have otherwise sold to the US to try and sort of find other markets and reduce prices, or if not reduce prices, at least to offer a different set of things. Along with that, I also think that means there's also going to be more pressure on the global economy. This is the one I'm somewhat more uncertain of, for the reason that at the end of the day, yes, the US is really important in terms of trade, but in terms of the share of what it buys from abroad and the other factors, that might happen on other policy fronts within the Trump administration, I think there's going to be some back and forth on that, of which way that goes, and that I'm not very clear on. So, in terms of sorry, Rebecca, in terms of sort of what happens, thinking of the small firms, so at least sort of broadly speaking, what we know from the trade literature, I'm going to give you the broad answer first and then say, well, what are we hearing? The broad answer seems to be small firms are able to sell to places where they can access markets most easily, simply because these tend to be less productive. And I'm putting that in quotes because we're not talking about efficiency, we're talking about profitability. So these firms do, and because the EU being the closest market, they were able to access that very quickly, very easily before. And now with trade barriers having gone up, particularly what we're hearing from everybody, and I keep hearing this over and over again, not just from the surveys that we look at, but also from the agents, that paperwork seems to be a very important issue. Compliance with the paperwork, really hard to get lawyers and accountants if you're a small business to give you very specific advice on these things, and that seems to be mattering, and that's where you're seeing the impacts happen. So I find that very plausible, a story. You might say actually productivity growth-wise that might cut the other way because of the composition effects, which is that now you might see that because you don't have these small firms in the economy, activity shifts towards these larger firms and we see productivity growth. But that being said, you're not really seeing as though somehow there's been this massive increase in market share coming from big businesses. Yes, they've dealt with the paperwork and those sorts of things much better, largely because they tend to be global businesses. They know how to deal with those things. But more and more, some of the work that I'm doing is looking at services trade, which is big firms. These are not small businesses. And there you do tend to see that some of these effects are starting to play a role. So what we've done is we've basically codified all of the TCA, said, okay, here is a service, here's France that said that you have to have such certification if you want to have accountancy services trade with me. And you are seeing that there's a negative impact there. We're still not sort of giving very concrete numbers because the trade data got revised a lot. We've gone and re-estimated stuff, but we still don't have access to the actual trade values. We can only tell you on the extensive margin what's going on. So that I think is really going to be critical for productivity growth. And that's basically what we want to explore, that how much does this matter for productivity? Because this is where productivity growth has come from. So are we sort of doing something on that front or not? That's the best I have at the moment.
Okay, next round of questions. Who would like to a question to Swati? Yes, please.
Call return, which at NIESR and others, in fact.
It's an ECB. It's an ECB working paper. I don't think it's an European Central Bank working paper.
Oh, right.
So they've reviewed a whole bunch of work and then come up with this sort of analysis.
Okay, gentleman here.
Yeah, just sorry, Theo Marks Clark from Rockers Capital. You mentioned sort of what you advocated for deeper sectoral work that central banks are trying to do and should be doing. I think you just gave a little example of it there. But is that something that Bank of England is going to be doing more of, sort of post-Bernanke review? Is that part of the forecasting infrastructure going forward, thinking in those terms? Because it sounds, you know, it should be.
So I think it's not solidified to the point that I can give you a very precise answer for that. I know at least Claire Lombardelli, who's leading that work, comes from that sort of persuasion. So I expect that's something that is going to feature. And, you know, unfortunately, that's been a huge lesson from the coming out of the pandemic, as well as the Ukraine war, that, you know, as I said in my last talk, that we didn't even have enough knowledge of targeting those energy subsidies precisely, even though you would think that, you know, having an electricity meter, like you can't get more bricks and mortar than that. But even that is very difficult to do in a very quick time period. But if we have those kinds of statistics with us, you know, you could have, in principle, saved so much money. Charlie is here. He's the one who's going to make a case for these sorts of statistics to be incorporated. I think he has more influence than I do.
Yes, please, gentleman in the middle.
Yeah, thank you very much indeed. David Owen from Marsh Economics. So, UK exports to non-EU have not performed particularly well either of goods. And I was wondering what you had a pressure on that. And the other thing which always surprised me was, I assume given services in many ways you're able to restrict service access much easier. As you're describing, you can just say certification, or you can say lots of different ways you can restrict service access. UK exports and services generally have actually, I think, outperformed what I certainly expected. And also, I view London as like a conduit in, you know, US. The surplus we have in services in the US is a lot of it is into the EU market. And again, we haven't seen this massive shift of service into, you know, Euro rates desks aside. We haven't seen a massive move. So I'm just wondering what comments on that, because these things have certainly surprised me.
No, absolutely. I think it surprised everybody. Sorry.
No, it's fine. Go ahead.
Okay, I'll go ahead.
Go up. Please.
So you're going to pit me against two of my colleagues who are also pitted against each other on what the right metric should be. Of course, the real question is, well, what's your counterfactual? If you thought, which way do you think goods trade should have moved? I think one thing we can all agree on is that we would definitely expect that EU trade would have taken a hit if there are new trade barriers being erected with the EU per se. That being said, and in that case, your counterfactual would be what's happening to non-EU trade. That being said, it's not as though economies of scale don't exist in the EU and non-EU markets. I mean, you know, so that's one of the views that John Springford would give, that no, you know, these supply chains matter. And if you're losing access to EU market, the non-EU business is also going to go away. And therefore, that actually might be that the goods trade weakness on non-EU might also be showing what is happening sort of as a result of increased trade costs. I'm a bit more open-minded still about it. I don't want to take a very strong stance because I think this is as much as we know. We don't know more than that. Do I have better ways of telling you, can I tease apart more of these effects and really precisely pinpoint them to the trade costs that have increased? Is it happening more in sort of sectors where trade costs increased a lot versus others? That sort of analysis is not quite there. And, you know, I mean, the data is lagging massively. So we're not able to actually do these things. On the services side, I know we're all congratulating ourselves. Services exports are looking very good. They're looking very good everywhere in the world. So we're not exceptional. We're really sort of looking very similar to everywhere else. So the analysis I am talking about, now there are different things emerging, and to some degree from some sectors you can start to hear stories. Now these are still stories. I have a student who is working on financial services and is tending to find that you do seem to see that there is some kind of EU, non-EU rebalancing happening. It's early work, we can't be certain. And the work that I've been doing is actually suggesting that if you look at services more broadly, all of them, then no matter how you cut it, whether you cut it with a counterfactual of EU versus non-EU, whether you cut it as a counterfactual of where sectors that have experienced higher trade barriers versus lower trade barriers, all of these seem to be pointing in a somewhat negative direction. The numbers are not big, the values start to look really big sometimes. And the reason I'm not sort of taking a stance on that is because the services trade data at the moment is in a fairly, it's getting revised a lot. And I don't, having previously said something and then realize it's been revised out, I'm being very cautious about what I say. I think that the trends are looking like they're going in that direction, but let's see as we get more data what things start to look like.
Okay, more questions. Yes, please. Go. No, you have another one. Absolutely.
So, you mentioned a lot about the monetary policy impacts of trade fragmentation on trade law. I've heard, sort of thinking a bit broader than monetary policy and perhaps getting to territory that affects fiscal policy more. I've heard some economists argue that if there is a trade war focused outside of the UK, so US to China, maybe US to EU, that could be positive for the UK's terms of trade in the sense that we can benefit from cheaper imports from one set of countries and also a competitive advantage in our exports to the US, say. So do you think that's plausible? Do you think that's quantitatively significant? And then maybe how might those kind of effects also affect monetary policy?
So not quite on the fiscal policy side necessarily, but that's a little bit the mechanism that in all of these models is driving the global price pressures to go downwards, which is that, the Chinese exporters who would have sold to the US now can't sell to the US. So the world price, because you've taken a chunk of US demand out of the system, is going to put downward pressure on global prices. That's the broad mechanism which is in all of these sorts of settings and which is somewhat to some degree witnessed in the previous Trump trade war. Now, that's the bit which I think if there is more sort of, if the magnitude of these trade barriers is high, that there'll be more of an impulse for that to happen. But does that translate into deflation or inflation in the other direction if you were thinking of the other side? I'm not certain about that. In fact, my sense would be that unless there's some sort of strange ratchet effect that you're going on, that this is going to be somewhat of a slow one-off adjustment. I mean, trade numbers don't move very much year to year even. They're fairly sort of stable things, and even rewiring of supply chain. Yes, we've been hearing about them for now, many years, but they're not very sort of quick moving things, is my sense. So,
do you think the other leg of that is quantitatively significant though? The sort of higher US demand for UK exports potentially.
I mean, given our general export performance, I'm not going to say that tomorrow we're suddenly going to see really serious export growth happen.
Got a question, gentleman at the back.
That's what Jack me from Barclays. I wondered if I could try and get you to bring together two parts of the speech. So the kind of the part on the UK EU realignment and then the part on tariffs. I know we can't kind of get into precise quantifications of these things, but just maybe in a relative sense, how do you think one should think about managing those two things if they're not entirely compatible in a kind of geopolitics world? So a closer EU realignment obviously has beneficial, maybe kind of non-inflation growth positive effects, but that may increase the risk of UK-US tariffs. So in that world, in a relative sense, how do you think about weighing these two things up?
This is best answered by somebody who's in the diplomacy unit of DBT. I mean, not even the economist can give you a very good answer to this. But that being said, I've written about this a lot before, which is that at that point, it seemed like you've got to think of which your larger market is, where you're more able to sell things to, where you're more aligned already. And those things, those just fundamental things, I mean, they don't change overnight. And I think that bit stays where it is. Then the slower moving, the kind of faster moving pieces of that, which is, do we start to see more retaliation coming if we're not aligned one way or the other? I just don't know. It's too complicated, or rather, I'm too unaware of what the diplomatic issues there would be. It's going to depend on those things.
Any more questions from anyone? Even if it's a second, third, or indeed a fourth question? No? Oh, yes, please, go ahead.
It's not really a question, but just as a Reuters reporter, thank you for giving me flashbacks to that night on Brexit in 2016. I was sitting next to the correspondent who was covering the sterling market that night. I was asking him to check his sense of reality at what was going on. And also just one other point. I think some of the little tiny blip up we saw in the value of sterling just before the massive fall was when Nigel Farage came out and said he thought that Remain had won it, which seemed to be a bit of a strange statement to make at the time. It's investigated after. But I think that was something to do. But thank you very much.
No, absolutely. 10:15 p.m. precisely, the exit poll comes out, and the statement was Remain seems to have inched it and sterling moved up.
Well, on that interesting moment, before thanking our 2025 Dow Lecturer, just a couple of things. One is you'll be very, I think, relieved to hear that we have some drinks and nibbles next door for you to enjoy after the lecture. So do please come and continue the conversation in our craft room, named after Nick Crafts, another person who did a lot of work on trade, on growth, on productivity. So do join us in the craft room in just a moment. If you have enjoyed today's event, which I very much hope you have, then please do consider becoming a member of NIESR. NIESR membership has lots and lots of benefits. I can't list them all. I was desperately trying to find a message from my colleague Neil. I couldn't find it. It's the trouble with emails. They're all sort of bound up in chains. You can never find anything. But the benefits include attendance at events or special invitations to events such as these, but also governor talks. We have some 140 governors of NIESR, some of whom are here this evening, and they come and give wonderful governors talks in this very room. So you'd be very welcome at those. You'd get privileged access to our global economic outlook. Whatever your views on forecasting and modeling, you would get access to our UK economic outlook. Again, the same caveat applies, and lots and lots of other benefits. Do please consider it. I think there's a little leaflet on your chat, so take that away and consider becoming a NIESR member. But now I would like to thank Swati Dhingra very, very much for a wonderfully stimulating lecture. Great discussion. Thank you for all of your questions. So please join me in thanking Swati Dhingra.